Are you in search of the best investment accounts for your children? Welcome, and thank you for joining us as we journey into the world of financial planning for the young ones. It's never too early to start investing for your child's future, and the earlier you start, the better. Today, we're going to explore 5 fantastic investment vehicles that can help secure a financially stable future for your children. We'll be discussing custodial Roth IRAs, which are an excellent way to introduce your child to the concept of retirement savings. Next, we'll dive into UJIMA and UTIMA accounts, followed by an exploration of brokerage accounts. We'll also look at 529 accounts, a favorite among parents saving for their child's education. Lastly, we'll touch upon Coverdell Education Savings Accounts, another education-focused investment vehicle. Stay tuned as we delve into these investment options, their benefits and drawbacks. It's time to take the first step towards securing your child's financial future. Firstly, we explore the custodial Roth IRAs, a retirement savings vehicle with a twist. Now you might be wondering, what exactly is a custodial Roth IRA? It's a type of individual retirement account, IRA, that parents or guardians can open for their children. The key here is that the child must have earned income, whether that's from a part-time job, babysitting, or even a summer gig. The beauty of the custodial Roth IRA is that contributions are made with after-tax dollars. This means that although there's no immediate tax break, the money grows tax-free. And when the time comes for your child to retire, they can make withdrawals tax-free as well. Imagine that, a golden nest egg waiting for them, and it's all tax-free. One of the main advantages of a custodial Roth IRA is the power of compound interest. The earlier the money is put into the account, the more time it has to grow. And remember, because it's a Roth IRA, that growth is tax-free. This can be an excellent way for children to learn about the magic of investing and see their money grow over time. However, like all good things, there are some drawbacks. For one, there are contribution limits. As of today, the maximum annual contribution is $6,000 or the child's total earned income for the year, whichever is less. This limit may change in the future as it's periodically adjusted for inflation. Another potential downside is the early withdrawal penalties. If your child decides to withdraw any earnings before age 59 and a half, they could face a 10% penalty unless it's for a qualified reason like buying a first home or paying for education. To sum it up, custodial Roth IRAs can be a powerful tool for teaching children about investing. They allow children to start saving for retirement at a young age, enjoy tax-free growth, and learn the importance of long-term financial planning. The contribution limits and early withdrawal penalties are things to keep in mind, but the benefits can far outweigh these considerations. Custodial Roth IRAs are a great way to teach children about investing while preparing them for retirement. Next, let's examine UJIMA and UTIMA accounts, flexible investment tools for minors. UJIMA stands for Uniform Gift to Minors Act, and UTIMA stands for Uniform Transfer to Minors Act. Both are types of custodial accounts that allow adults to transfer assets to a minor without the need for a trust. These accounts can hold a variety of assets, including stocks, bonds, mutual funds, and even real estate. One of the key benefits of UJIMA and UTIMA accounts is their flexibility. Unlike some other investment accounts for minors, there are no restrictions on how the funds can be used, as long as it's for the benefit of the minor. This means the money can be used for anything from education expenses to buying a car or even a down payment on a house. Another advantage is that there are no contribution limits. You can contribute as much as you want to these accounts, making them a great option if you're looking to transfer significant assets to a minor. However, there are some drawbacks to consider. One of these is tax implications. While the first $1,000 of unearned income in the account is tax-free, and the next $1,000 is taxed at the child's rate, any amount over $2,000 is taxed at the parent's rate. Another potential downside is the loss of control over the assets when the child reaches the age of majority, which is typically 18 or 21, depending on the state. At this point, the assets in the account legally belong to the child, and they can use them however they wish. This means that if the child decides to use the money irresponsibly, there's not much you can do about it. Despite these drawbacks, UJIMA and UTIMA accounts provide an excellent way to transfer assets to minors without the need for a trust. They offer flexibility and simplicity while allowing you to provide a financial head start for the minors in your life. UGMA and UTMA accounts provide an excellent way to transfer assets to minors without the need for a trust. Now on to brokerage accounts, a versatile investment option. Brokerage accounts are essentially a platform that allows you to buy and sell a wide variety of investment options, including stocks, bonds, mutual funds, and ETFs. They are provided by brokerage firms, which act as a middleman between investors and the market. One of the main attractions of brokerage accounts is their versatility. Unlike other investment accounts that limit you to certain types of investments, brokerage accounts offer a broad spectrum. Whether you're interested in blue-chip stocks, high-risk, high-reward startups, government bonds, or diversified mutual funds, a brokerage account gives you the freedom to choose. Another significant benefit of brokerage accounts is there are no contribution limits. You can invest as much money as you want, whenever you want. This feature is particularly beneficial for those who are looking to make sizable investments on behalf of their children. However, it's essential to note that brokerage accounts come with their own set of drawbacks. The most notable one is that they are taxable. Unlike some other investment accounts designed specifically for children, brokerage accounts don't have any tax advantages. The income generated from these accounts, whether from capital gains or dividends, is subject to taxation. Furthermore, brokerage accounts are not specifically designed for children. This means that, in most cases, an adult needs to open and manage the account on behalf of the child. It's crucial to understand that this may involve additional responsibilities, including tax reporting. Despite these drawbacks, brokerage accounts provide a great opportunity for parents and guardians to invest in a wide array of securities on behalf of their children. They offer flexibility and the potential to build substantial wealth over time. But remember, as with all investments, brokerage accounts come with their own risks. It's always a good idea to consult with a financial advisor before making any investment decisions. Brokerage accounts offer an opportunity to invest in a wide array of securities to build wealth over time. Our fourth type of investment account is the 529 account, specifically designed for education expenses. Named after Section 529 of the Internal Revenue Code, these accounts provide a tax-advantaged way to save for a child's education. They're like the Swiss Army knives of education savings, versatile, powerful, and ready to tackle any challenge. But what exactly is a 529 account? Well, it's an investment account where contributions grow tax-free as long as the funds are used for qualified education expenses. These expenses can include anything from tuition for K-12 private schools to college tuition, books, and even room and board. One of the major benefits of 529 accounts is their high contribution limits. Unlike other investment accounts for kids, 529 accounts allow you to contribute large sums of money, often over $300,000 over the lifetime of the account. They're a great option if you're looking to save big for your child's education. Another perk, the tax advantages. Not only do contributions to a 529 account grow tax-free, but withdrawals for qualified education expenses are also tax-free. It's a win-win situation that can save you a significant amount of money in the long run. But, like all good things, 529 accounts come with their own set of drawbacks. The main one being, if the funds are used for non-education expenses, you'll be hit with income taxes and a 10% penalty on the earnings. So, it's crucial to plan wisely and ensure the funds will be used for their intended purpose. Also, while 529 accounts are a fantastic way to save for college, they may not be the best choice if your child decides not to pursue a higher education. So it's always a good idea to consider other investment options as well. In a nutshell, 529 accounts offer a powerful, tax-advantaged way to save for your child's education. They're not without their limitations, but their benefits often outweigh the drawbacks, making them a popular choice for many parents. 529 accounts are a fantastic way to save for your child's education expenses. Lastly, let's discuss Coverdell Education Savings Accounts. another education-focused investment tool. Coverdell Education Savings Accounts, also known as ESAs, are tax-advantaged investment accounts designed to support future educational expenses. Now, what makes these accounts stand out? Well, there are a few key benefits. First, any earnings in a Coverdell ESA grow tax-free. That's right, you won't pay a penny in taxes on the account's growth. And when it's time to pay for educational expenses, withdrawals are also tax-free as long as they're used for qualified education expenses. Secondly, unlike 529 plans, Coverdell ESAs can be used for K-12 expenses. This includes tuition, books, supplies, and even uniforms for elementary, middle, and high school. So if you're planning on private schooling or foresee other K-12 costs in your child's future, a Coverdell ESA can provide an effective way to save. However, it's important to be aware of the limitations of Coverdell ESAs. The annual contribution limit is fairly low, currently capped at $2,000 per child per year. This is significantly lower than the limits for 529 plans, which can sometimes be as high as the total cost of attendance at the most expensive college in your state. Another potential drawback is the income restrictions. To contribute the maximum amount to a Coverdell ESA, your modified adjusted gross income must be less than $95,000 for single filers or $190,000 for joint filer. Above these income levels, the contribution limit begins to phase out. Despite these limitations, Coverdell Education Savings Accounts are an excellent tool for parents who want to start saving for their child's education early. They offer tax advantages, flexibility in how funds can be used, and the opportunity to invest in various types of assets. So if you're considering an education-focused investment for your child, a Coverdell ESA is certainly worth considering. Coverdell Education Savings Accounts are excellent for parents who want to start saving for their child's education early. Investing for your child's future is a significant responsibility and opportunity. Remember, custodial Roth IRAs allow your child to start saving for retirement early with tax-free growth. UGMA and UTIMA accounts offer a flexible way to invest in nearly any asset, but they do come with fewer tax advantages. Brokerage accounts, on the other hand, provide great flexibility but with fewer tax benefits. And then we have 529 accounts, specifically designed for education expenses with substantial tax benefits but less investment flexibility. Last but not least, Coverdell Education Savings Accounts also focus on educational expenses but offer more investment options and lower contribution limits. Choosing the right account depends on your child's needs and your family's financial situation. It's about balancing flexibility, tax benefits, and the purpose of the investment. So take your time, do your research, and make an informed choice. If you'd like to hear more about personal finances, please like, share, and subscribe.